Hey there, good evening, everyone. It's Wednesday, June 18th, and welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you from a beautiful Southwest New Hampshire at Walden School at a music camp here all week up in the hills of New Hampshire with performers, composers, and a lot of creative people. And it's been an absolute blast. Sadly, I'm already halfway done with this week, but it's been awesome. I've been playing a lot, singing a lot, meeting other people, talking about music, listening to music, performing music. It's a real pleasure to be up here. I hope that it allows me to come back more rested and better than ever in terms of my interest in keeping Chart This top of mind for all of you. And I appreciate your flexibility, allowing me just completely disrupting the schedule this week, so I have the ability to come up here. Today, Fed Day. Sort of a quiet day yesterday going into today's session. The good news is we didn't go down a ton after the Fed announcements. And again, not much. I mean, it's sort of much ado about nothing more than anything. The bad news is we closed down at the lows of the day. So if we're looking for the Fed meeting to be this positive catalyst propelling the major averages out of their recent congestion zone, it's not going to happen. We're also going to look at a series of charts today. We'll talk about how those divergences we've been highlighting continuing to follow through. We'll talk about how measures of breadth and momentum have continued to deteriorate. Talk about what happens to your company and to your stock if your business is in payment processing, and this whole stable coin thing all of a sudden makes it look like what you're doing maybe a little more obsolete than you thought. With that in mind, let's get to the charts and see how things played out today. Looking at the major averages here at the end of the day, you can see yesterday and today actually had a remarkably similar contour to the day. In both cases, we had kind of a nice rally in the first hour of trading. Both days, we ended up having a top sort of in the 10:30 a.m. range. Today or yesterday hung in there a little better. Today sort of rolled off right after that open. We had spikes higher around the Fed announcement at 2 and the beginning of the Fed press conference. But through the course of the press conference, markets actually rotated lower by about 3 p.m. Eastern. The S&P was below yesterday's low, and that's pretty much where we finished, just slightly below Tuesday's close. That makes the S&P flat for the day, basically almost exactly where we started or where we ended the day yesterday. NASDAQ slightly higher, Dow slightly lower. So in the end, not much of a big movement. The S&P small cap index, the 600, was up about 0.4%. That's your best performer out of the group. But again, nothing really moving a ton today. Even though the markets were down, the VIX actually drifted lower today. So about 1.5 VIX points to the downside. Earlier in the day, it was below 20. It actually held that 20 threshold going into the close. So I would, again, say that's an important level to watch. Yesterday, we had spiked back above 20. Today, kind of toying around with that level. The further we get above 20 and stay there, the more concerning I would say this particular market environment is. Looking at bonds, not a big movement day. It actually was a bit of movement through the course of the day, but in the end, bonds actually rallied out of the open, sold off, into the afternoon. So the TLT basically finished slightly higher, but not much of a change. Interest rates basically were in line with where we were yesterday. No big risk-off move through the course of the day. And the dollar, not a big movement day either. Keep in mind, by the way, tomorrow is the Juneteenth holiday. So June 19th now, a federal holiday. Markets will be closed tomorrow. We'll be taking tomorrow off, focusing on music up here. Hope you're able to take some time and enjoy that holiday. And we'll be back with an all mailbag episode on Friday at some point when I can fit it in with the schedule here. So no show tomorrow. And so a little quiet going into this break tomorrow. Having said that, gold and silver both drifting lower. Oil prices essentially flat for the day as in the form of the USO. And natural gas prices, one of the better ETFs, up almost 3% today. Cryptocurrency is kind of in a risk-off move. It happened yesterday and really continued today. Today was kind of a choppy session. We're currently around 104,500 for Bitcoin. Ethereum about 1/3% higher. Just not a big movement day all around. I would say overall, this is an underwhelming day. And I think the problem is if you're on the bullish side, no real upside follow through after the Fed meeting. 3 top sectors today, again, not up a ton, but utilities were the best performer, up 0.3%. Real estate up 0.2%. Technology continuing to impress, continuing to outperform, continuing to be arguably the best sector on a relative basis in 2025, up 0.1% today. You can see about half of the S&P sectors were down. led by energy, which was actually down 0.2%, materials down about 1/3%, industrials down about 1/4%. So again, ended up being kind of a quiet session here. The breadth overall was kind of meh. I mean, the mid cap breadth was more positive, about a 2-to-1 ratio of up versus down. The rest of the breadth readings mostly neutral, right? So on the S&P, for example, almost a coin flip between the two. So this wasn't a big, up day or down day. It wasn't a big accumulation or distribution day. It was really more kind of a subtle wait and see day going into the weekend. We are going to talk about Coinbase, which ended up being the top performer in the S&P 500 today. The news on stablecoin really helped propel that to the top of the leaderboard. On the Magnificent Seven and Friends, these mega cap growth leadership names, you can see Tesla up 1.8%. That was the best performer. NVIDIA, which has been a fairly strong chart along with other semiconductors here in June, up almost 1%. Broadcom up about 0.75% as well. Alphabet getting dinged about 1.5%. Amazon just over 1%. And Meta just under the zero line for the day. All right. Shall we look at the market carpet and see how things played out today? Jumping off the page, the red there for Visa and MasterCard, these are the payment processors. So news was that Senate approved the stablecoin bill, which basically juiced Coinbase to the upside and dropped payment processors. The idea here, the implication is that eventually this stablecoin model basically eliminates the need for payment processors. It would allow a decentralized way of processing payments is sort of the expectation or sort of the eventual goal there. So, the news hit today, Visa and MasterCard both down about 5%, Coinbase up over 15% by the end of the day. Otherwise, not a big movement today. You can see some random names that were up or down quite a bit, but overall, this was a fairly quiet session as I'm reviewing the charts here. And I would say, given what we've talked about, right, the way you use a heat map in this particular type of environment, think about the sort of overall bias that we're talking about. The long-term trend's still quite strong. In the short term, we're seeing quite a bit of concerning developments in terms of the leading indicators for a market top. Things like breadth weakening, momentum weakening, leadership changing. Those are the kind of things that we're starting to recognize. But what you now start to look for are legitimate changes. And I would say one area would be the rise in defensive sectors. You're not really seeing that yet, right? I mean, if you look at the defensive sectors like utilities, consumer staples, they don't look too dissimilar from healthcare, consumer discretionary, communication services are all kind of similar looks to the chart. If things really start to get concerning, you would expect to see defensive sectors do a lot better. So keep an eye on utilities, on REITs, on healthcare, on consumer staples. And those higher yielding, sort of more lower beta defensive sectors, if those start to improve, and particularly if they start to outperform, that's where I think you want to start to be concerned about potential further downside for equities and other risk assets. All right, we'll continue on. Again, an abbreviated show this week, and I appreciate you hanging with me as I do the show remotely here, and grab some time to review the charts and share them with you when I can. I did want to let you know, by the way, before we get to the charts, special right now for Seeking Alpha. It is their summer sale. Very rarely they do a full 20% off. That's on Seeking Alpha Premium, on Seeking Alpha Alpha Picks, on the bundle, combining some of those features. If you go to my link, marketmisbehavior.com/Seeking Alpha, or just scan the QR code that you see on the screen, you can check out all the details on the special. By the way, if you sign up using our link, you'll get a 7-day free trial so you can check everything out. You'll also have full access to a special second half of 2025 Outlook event that they will be doing, featuring Steve Kress, who's the head of the quantitative effort at Seeking Alpha. I interviewed Steve on my podcast earlier this year. Check that out. You'll get a sense of the quantitative horsepower they're using to feed their analytical models. I've used Seeking Alpha. I'm a big fan of how they take institutional quality quantitative methodologies and scanning tools and put them in the hands of individual investors and advisors. So I'd encourage you to check it out. Again, go to marketmisbehavior.com/Seeking Alpha, or just scan the QR code on their screen to take advantage of their summer sale. All right, continuing on here, let us go to the charts. And we're going to start with the chart of the S&P 500. Not a huge change, but I just want to point out, yesterday we're talking about this divergence, right? Higher highs in price, lower peaks in momentum. That's still very much the case here today. But take a look at the last 2 trading days and look at the bars here, right? Actually, 3 of the last 4 trading days we've traded and had some noise during the day, but closed near the lows of the day. And particularly the last 2 days, as we start to see this, I think, validation of the divergence. What you need is a pullback off of that second high. And I think this week we're certainly seeing that distribution after Monday's pop higher. Tuesday, Wednesday now finishing more toward the lows of the day. And that's going through the June Fed meeting. So no real love there in terms of optimism coming out of the Fed. It sort of seems like, still an open question as to what they're going to do. But, expecting potential rate cuts happening later this year. The September meeting is when the market is pricing in a first rate cut, by the way. We'll keep an eye on that, on how that might change after this meeting. Sometimes there's some change in the expectations, but nothing to report just yet. Just want to update a couple of these charts that we highlighted yesterday in terms of breadth. Again, keep an eye on the percent of stocks above their 200-day moving average. It's dipping below 50% this week after being above 50% for the last couple of weeks. That's, again, a concerning development, because the lower that reading goes, the more that, even if the S&P and the NASDAQ are holding their 200-day moving averages, a lot of individual names, members of the S&P, are not holding the 200-day. That's usually what a bear market rotation looks like. Also, less and less stocks holding their 50-day moving average, more of a short-term breadth indicator, but something to watch. The bullish percent index on the S&P 500 now firmly below 70%. That happened this week. And check this one out. We talked about this yesterday, and it had not broken until today. We now have less than 70% of the S&P the NASDAQ 100 members in a bullish point and figure methodology, or bullish point and figure pattern. Back here in mid-May, about a month ago, we're at 85%. Now we're just below 70%, which means about 15, 17% of the NASDAQ 100 names have now broken down and are in a sell configuration on their point and figure chart. That doesn't just happen. It takes quite a lot to actually generate those sell signals on the point and figure chart. So I think the fact that those are rotating below 70% is a real issue. And if you look back on the chart, you can see some significant market peaks happen when we go above 70% and then come back below. That's one of my favorite breadth indicators to track a potential top, because these are the growth leadership names. These are the big growth stocks in the NASDAQ 100. And if they all go above, if so many of them are in bullish signals, that's how a market is driven by growth leadership. But when that starts to break down below the 70% threshold, which again, it did today, that often means a concerning rotation in some of the top names that should be driving the market higher. We highlighted the divergence in the Chaikin money flow. I have to tell you today, we are, a penny below the zero line, but we definitely got right to that point today. So we'll keep an eye on this one going into next week. But again, a divergence is what often happens right around peaks. And then in the initial distribution, you'll see this rotate. And if we get below zero, that tells you the market is in a distribution phase, because there's heavier volume on down days than up days. And that tilts the indicator back negative. That's sort of the classic sell signal using the Chaikin money flow. May have happened today. We'll have to see on Friday if we follow through. But I think going into next week, that'll be an important chart to watch. Let's watch the VIX as well. We pulled back a little bit on the VIX. It did hold 20 just slightly at 20.1. But overall, a VIX above 20 means a high volatility environment. And if next week we rotate higher, that would be a big warning sign for equities. Now, one thing you're not really seeing, I talked about changes to detect. We've had some of the early warning signs, weaker breadth, weaker momentum. That's happened now from May to June. One thing we've not seen is significant changes in leadership. We've seen some of that, like with energy starting to really outperform, but we're certainly, not seeing it in the defensive sectors. And if you look from mid-April to now mid-June, the 4 defensive sectors from the top, utilities, healthcare, consumer staples, and real estate, all have underperformed in the last month. The warning sign here would be these defensive sectors starting to improve. And again, we're looking at the relative strength ratios. So if these lines go up, they might still be going down, but they're going to be outperforming the S&P. And that is usually a good validation that a distribution phase is in place. Now, we're still seeing leadership in technology. It has been the best sector off of the April lows. In the month of June, the best sector along with energy. And I would say semiconductors in particular, a great space to watch. We've highlighted NVIDIA, of course, one of the top performing Magnificent Seven stocks. in the last month, and we're also seeing it with the other semiconductor names as well. Here's the SMH gapping above the 200-day, holding the 200-day, and then breaking higher. No real divergence on the chart of semiconductors, and the relative strength still looking really good. So despite what you may think about the markets, even if you're concerned about the markets, I have no problem owning stocks and groups and ETFs that are outperforming. Whether or not you think they should, the chart is telling you they are. One last chart to review with you. This is what happens when your business is based on payment processing. Visa and MasterCard both dropping about 5% today. Visa breaking below its 50-day moving average. I did not grab the chart of MasterCard, but it's actually threatening to get down to its 200-day moving average. There's a breakdown in the relative strength. At the same time, you can see Coinbase, which is basically on the positive side of this news because they traffic in stable coins. So something good for stable coins and bad for payment processors means Visa and MasterCard start to drop and Coinbase starts to rip higher. Now, Coinbase has already been doing pretty well, driven in no small part by the strength in Bitcoin over the last 2 months, but that continued follow through, breaking out of this resistance as we pull back to the 200-day moving average, I would consider a fairly constructive development. That's a quick review of the charts as I see them. I appreciate you guys so much tuning in to this abbreviated version of Chart This with Dave Keller. We'll be at Music Camp here the rest of the week. No show tomorrow due to the federal Juneteenth holiday. We will have an all mailback episode on Friday. So please get your questions in. If anything has come up based on the content of the show, some of the content that you've seen of mine elsewhere, or just things you're running into, tickers to review, charts that don't make sense, indicators you're thinking about, macro environment questions, whatever it is, anything's fair game. We'll take a look at those and feature some of the top questions we received on Friday's episode. But that's it for today. Thanks so much. For Market Misbehavior, I'm Dave Keller. Have a great one. And remember, it's always a good time to own good charts.